Welcome to this explainer. We're jumping right into unpacking the updated licensing exemption framework for single-family offices, laid out by the Monetary Authority of Singapore. Look, if you're managing family wealth, knowing the regulatory landscape isn't just helpful, it's absolutely crucial. The MAS has set some very specific guardrails, and we're going to make sure you're intimately familiar with them.
So how exactly do you navigate these regulations to keep your SFO fully exempt? Let's figure that out. We know that managing your own family's assets shouldn't require the exact same massive compliance overhead as a commercial fund manager handling third-party money, but that's only true if you stay within the lines.
To make this dense regulatory text easy to digest, here is what we are covering today. 1. The exemption conditions. 2. The two 10% rules. 3. Defining the family tree. 4. Banking and AML requirements. And 5. Navigating reporting timelines.
All right, Part 1, the exemption conditions, and how to properly structure your SFO.
Right off the bat, the first check is structural. Your single-family office literally has to be incorporated right here in Singapore. Now, the MAS is actually pretty flexible when it comes to the legal vehicle you want to use. You can hold it via a trust, a foundation, or really any other standard legal structure. But here is the absolute non-negotiable part. The funding of the SFO has to originate exclusively from members of the same family or a specifically designated group of key employees. There is zero tolerance for third-party money here.
Moving on to Part 2, the two 10% rules, regarding those key employees.
This is where a lot of folks get tripped up, so let's clear the air completely. The famous 10% rule actually applies in two entirely separate contexts. First, there's the ownership stake limit. A key employee is allowed to own a non-controlling stake of up to 10% in the SFO entity itself. Second, and totally distinct from corporate ownership, is the limit on assets under management, or AUM. The total assets originating from your key employees must never exceed 10% of the SFO's total managed assets in aggregate.
Think of your total managed wealth like a giant pie. No matter how much that pie grows, shrinks, or evolves over time, the assets that come from your key employees can never, ever cross that 10% slice. The remaining 90%? That must always be family money. It's a really smart rule because it allows top-tier professionals to have some skin in the game without accidentally turning the SFO into a commercial fund.
And remember, you can't just hand this exemption to anyone. The MAS defines a key employee very specifically. We're talking about executive directors, the CEO, the CFO, and your core investment professionals. You can't extend this to random contractors or junior staff. It ensures the SFO primarily serves the wealth creators, while still letting you retain serious talent.
Okay, Part 3, defining the family tree and the 5-generation limit. When regulators say family, they obviously need a hard, quantifiable metric. So the rule hinges on identifying a common ancestor, who can be living or deceased. Basically, this common ancestor cannot be more than 5 generations removed from the youngest generation establishing the SFO in Singapore. Everyone from that ancestor down to generation 5 is within scope at the time you set it up. And the cool part is, once it's established, future generations can be seamlessly added as the family naturally grows.
And to be fair, the MAS is pretty practical about what constitutes a family these days. It's not just strict lineal bloodlines. The framework generously includes current or former spouses, adopted children, stepchildren, parents-in-law, and siblings-in-law, all within that 5-generation boundary. It really reflects the reality of modern blended families.
Let's shift gears to Part 4, banking and AML requirements. These are your non-negotiable operational mandates. Procedurally speaking, the MAS requires both your SFO and its Singapore-incorporated fund vehicles to maintain accounts with MAS-licensed banks. Simple enough, right? Now, if you're using a foreign-incorporated fund vehicle, there's a little more flexibility. You can use an MAS-licensed bank in Singapore or a regulated bank in a jurisdiction that complies with FATF standards. But don't expect a free pass. Wherever that account sits, those banks are mandated to conduct rigorous customer due diligence and ongoing anti-money laundering checks. They are essentially acting as the first line of defense for the regulators.
And finally, Part 5, navigating reporting timelines.
You essentially have 3 ticking clocks to watch here. First, when you launch, you have exactly 14 days to file your notice of commencement of business via the government portal. Second, you get a strict 4-month window after your financial year ends to submit your annual return. And third, if you happen to be an existing SFO that was operating before these new rules dropped, you've got a 1-year transitional grace period to get everything sorted, which officially ends on June 15, 2027.
Zeroing in on that annual reporting window for a second, you have exactly 4 months from the end of your financial year to file. And I really need to highlight a point the MAS explicitly makes. No further extensions will be granted. None. Period. Your internal accounting and compliance teams need to run like absolute clockwork to hit this deadline every single year.
Interestingly, when you actually go to file, there's a very specific signature requirement. You have to submit a declaration duly signed by a family member who provided the assets and a director of the SFO. If one person happens to be both, well, a single signature works just fine. But here is a genuinely great perk. You do not need to furnish a formal legal opinion to qualify for this exemption. The MAS trusts the SFO to exercise due care and self-assess without forcing you to attach incredibly expensive legal advisories to your forms.
So, as we wrap up this explainer, you now have a clear map of the operational limits, those highly specific dual 10% rules for key employees, the multi-generational family tree, and the unyielding reporting timelines. It leaves us with one massive question. Is your current structure truly prepared to meet these exacting standards? Take the time to evaluate your setups right now, before those strict deadlines creep up on you. Thanks so much for joining me on this deep dive, and keep learning.